inflation targeting in India, certainly a very big issue in central banking. And we will again have 45 minutes for the entire session. And the presenter of this paper is Rishabh Choudhary from the World Bank Group. And I see Rishabh, you're on. And would you like to share your slides?
Okay. Hi, so I'm Rishabh. I work as a consultant with the World Bank. Today I'm going to present a paper on inflation targeting framework in India. This paper basically provides an interim assessment of how the framework has been in the past 4 years, the performance of various indicators and other related analysis. So the presentation will go the following way. Firstly, I'll give a brief overview of the research question, key findings, and then a history of monetary policy framework in India. Move on to the data, some issues related to the data set, and then empirical finding, and then some caveats, limitations, and finally concluding with some suggestions for the future. So, inflation targeting framework in India was introduced in September 2016. It started with RBI, Reserve Bank of India, and the Government of India signing an IT framework in February 2015, which was later through an amendment in the Act introduced more formally, and the Monetary Policy Committee was constituted in October, and the first meeting was held in October 2016. The broad feature of this framework is that there's an inflation target, headline CPI, which includes core, food, and fuel. And the target is 4% with a tolerance band of 2 to 6%. And the 6-member Monetary Policy Committee is set up for 4 years. They are required to hold at least 4 meetings a year. And we have Professor Ghate, who's also a member of the meeting, Monetary Policy Committee. So, and the target rate is the repo policy rate. Now, in this paper, we basically see how the framework has performed since the framework was due for review in March 2021. Not the framework, the band, the inflation target and the band was set for review, and there was several criticism regarding this framework, that it has hurt growth and RBI has become more hawkish. This warranted an analysis, an interim analysis of the performance of this framework, and we begin answering these questions sequentially. We first start by asking whether there is a strong case for targeting core inflation instead of headline, because some critics have argued that food inflation is more volatile and hence RBI should rather target core inflation. And next question is whether RBI has become more hawkish since the introduction of the IT regime, and that is it is neglecting changes in the output gap while setting the policy. And next we see whether the inflation expectations have become better anchored since the introduction of IT. The literature suggests that in many IT adopting countries, this is the case. Expectations have become more anchored. So we test this case for India. And then we compare some economic outcomes, some financial variables, pre and post IT. This analysis is basically not about causation, but just to rule out any possibility of negative impact on these variables. Just to make a case that whether RBI has ignored these variables or they have just gone out of the previous historical averages. And then lastly, we see whether IT inflation targeting frameworks are well placed to allow the central bank to respond to the COVID shock. So here basically we see if there is a shock if there's an output shock, the central bank has enough flexibility to respond to that, keeping in mind that inflation could be a concern going forward. Now, just putting the key findings, we find that expectations have become better anchored, and a range of financial variables appear to be less volatile. And RBI is not obsessed with inflation, contrary to some critics. It does respond to the output fluctuations. And in fact, we find that the response to inflation has been less than before. And on the headline versus core as the target, we find that food price inflation do spill over into core, which can potentially de-anchor expectation, and by implication, RBI should respond to it. And lastly, we suggest that a credible central bank, as a credible central bank, the RBI had more room to respond to COVID-19 shock, despite the fact that inflation was already running at the top of its target range. Now, very quickly, I'll run through the timeline of monetary policy framework in India. It all started with the initial phase when we were targeting the exchange rate, sterling rupee parity was the goal, and then 1949 to 1969, the early phases of development, RBI's goal was to administer supply and demand of credit. And then 69 to 85 period was also dominated by priority credit uh, targeting by the RBI, because the goal was to stimulate growth and push up certain sectors. And eventually, RBI moved to monetary targeting frameworks, targeting money supply, and then in the past few years, 1998 to 2015, RBI has been adopting a multiple indicator approach, where the broader objective is inflation and growth, while targeting multiple indicators and using a broad set of information to achieve that goal. Now, since 2016, RBI has formally adopted this flexible inflation targeting, and as the policy states, the main goal is price stability while ensuring the uh, growth, overall economic growth in mind. And the target is the headline CPI inflation, as I said before. Now, quickly turning to the data, we have CPI headline inflation from 2012 onwards, and our analysis basically starts from 1997 second quarter, as GDP quarterly GDP series for India is available since then. So we do standard splicing method and use CPI industrial workers prior to 2012. Since CPI headline is not available, WPI is available, so we go with that. And when we do the reaction function estimation, since RBI monitored wholesale price inflation prior to 2014, as evident from the central bank statements and other literature on this, so we use WPI wholesale price inflation prior to 2014, and then we use the from 2014 onwards we use the consumer price inflation. And we restrict our analysis until the end of 2019, just because COVID shock, the effect of COVID shock was evident from 2020 first quarter. So to provide an interim analysis of this framework, we just restrict to the normal quarters. Now coming to the effective policy rate, this will be used in our reaction function estimates. Prior to 2002, we use bank rate, and for some periods in between, we use reverse repo because this is similar to Patra and Kapoor paper. Now the reason being is that when there is excess liquidity in the system and RBI is in absorption mode, it is more feasible. It is more correct. The correct way is to use the reverse repo rate instead of repo, and in other times we use the repo rate. So that's how we construct the effective policy rate. Now the empirical findings. Well, we start with this first result, targeting headline or versus core inflation. So we find that food inflation is not more persistent than the core inflation. Firstly, the persistence check come from various specifications. We start with a VAR model and with 4 different lags, and we see that food inflation persistence is not much different than core and headline. And then we move to some other test for persistence like dominant AR root test, half-life measure. All results more or less confirms that it is not more persistent than core. And another surprising, perhaps contrary to what other papers have found, we find that food inflation feeds into core, but it's not the other way around. And similar results are confirmed by the Granger causality test. So this basically makes us more strong understand that food price inflation should be included in the price index targeted by the RBI. Although RBI may not fully always quickly respond to it. But if there is a shock to food inflation, RBI should be cautious about it, instead of completely ignoring any such shock, because that carries the potential to pass on to core inflation. And next, we move on to analyze the stability of various outcomes, various macro financial indicators. The specification is very simple. We just regress the outcome on IT dummy, which is from 2016 Q3 onwards, and global financial control for the global financial crisis dummy and a post-global financial crisis dummy. The coefficient of interest is alpha 1. The interpretation is basically how the averages in that particular variable has changed. Now, well, this graph tells us that core, the CPI inflation, both headline and core, has been lower during the IT regime, and I've not shown the coefficient in the slides, but we do find that the coefficients are, the IT coefficient is negative and significant, and same is the case for volatility, which we measure as a 15-month rolling standard deviation. So the findings are consistent here, and just quickly showing you the results on volatility of CPI inflation. We find that it has fallen by, on average, by 80 basis points compared to normal average of around 200 basis points. And same is the, but here interesting point to note is that the same result doesn't hold for food inflation, because that's what RBI can't directly control over, but RBI has control over core, and so that's why through headline, through core, we see that impact in headline inflation. And next, the other variables we see, there's not much impact, no significant impact. Basically, the coefficient of interest is insignificant for variables like exchange rates, reserve movements, portfolio flows. However, we do find that exchange rate volatility has fallen. As you can see in this chart, there are no major spikes in the IT regime. There could be other reasons as well. As I said before, this is not, we are not establishing causality here, but the point is that it's not that RBI has become a completely obsessed. RBI has not been completely obsessed with inflation. Other goals are being monitored. Other indicators are being monitored. And on the real side, we use index of industrial production as a proxy for growth, just to analyze the volatility indicator, because it's available at monthly and we can compute the standard deviations. And we find that the volatility has fallen, but as contrary to what critics argue on the growth being negative, we don't find any such evidence that it has hurted growth. And similar thing hold for other components of general government. Now, one explanation for this last finding is that the RBI does respond to output fluctuations. It's not that it's completely obsessed with inflation. And as you can see in the first chart, the correlations pre and post IT doesn't seem to have changed much. And but for inflation on this in this rightmost chart, you see that it appears to have weakened further, in fact. And we interpret this as anti-inflation credibility post-IT, and other extensive tests also confirm this. Now, consistent with this interpretation, we also find that some evidence that expectations have become better anchored post-IT. So whenever there is a shock to inflation, it does not feed fully into the inflation expectations, as we can see. But that's not true for household expectations, although we find this result to be strong for professional forecasters' expectations. As we can see that there's a decline of 32 and 35 basis point in this CPI inflation coefficient post-IT. Next, and further consistent with this better anchoring argument, we find that there's a lesser tendency for expected inflation to feed into to actual inflation. And this is true for both professional and household forecasters. We basically use the simple specification where inflation is regressed on lagged inflation, which indicates persistence, and then on expectations. and then on output gap, and also on output gap, which is proxy for supply side shock. And we find that this pass-through has weakened from expectations to actual inflation. Now, coming to the last section on COVID and credibility, we now test whether this better anchoring means more ability to respond to exceptional shocks like COVID. And so despite this fact that inflation was running towards the top of the target, as we can see here in this chart, that headline inflation was like close to the upper tolerance band, but still RBI did respond by cutting the repo rates. Now, and this is not just for RBI, we test this for 27 IT and 43 non-IT countries. We find that average policy rates were in fact lower in the IT countries, and despite this fact, they were able to respond more aggressively by cutting the rate substantially. And also, we see in this simple table that average inflation rate was roughly the same in both IT and non-IT countries. And now this is true even if we control for inflation and use a variety of IVs. So because inflation targeting is not, the framework is not assigned randomly, so we instrument this using GDP, real GDP, and other indicators like World Bank measure of voice and accountability, regulatory quality. We broadly find that there is the IT targeting banks, the banks with inflation targeting frameworks did respond more aggressively to the COVID-19 shock. Now, there's several caveats and limitations of this. Firstly, it's a 4-period analysis, and that may not be enough to argue for a strong and robust case, but it does provide an interim analysis, some insights. And other factors like change of governorship and deputy governorship, even that too dominate even during this short period of 4 years. Well, the third caveat is India officially moved to IT from 2016, but the move started closer from 2014 onwards. But we did check some of the results, and like controlling for this dummy from 2014-15 onwards, when the central bank governor announced a gliding path towards inflation. So some of the results were robust to that. And on the COVID and credibility section, COVID-19 is still evolving. The current analysis dates back to, I think, mid 2020, sometime in mid 2020, and we haven't extended the analysis yet. And the situation is still evolving, so it's still premature to analyze the flexibility of IT in COVID case. Now, the suggestions for future is that if it ain't broke, then don't fix it. And so has the RBI done in the March review. RBI finally decided to, the government and the RBI decided to continue with this framework for another 4 years. And headline CPI remains the target band, and everything remains the same. And what suggestion for future? So one additional analysis could be on the household expectations, because we did find that the expectations, although have fallen with the introduction of IT regime, but there's still a systematic bias between the actual inflation and what the household expectations are. Professional forecasters' expectations are aligned with the actual one, but household series has a systematic bias. And then IT framework, we find in nutshell that it does have a inbuilt escape clause due to its flexible nature, as evident in the RBI's response to COVID. And in general, we have seen that RBI has responded to the changes in output gap. I'll stop there. Thanks.
Thank you, Rishabh. So to discuss the paper, we have Chetan Ghate from the Indian Statistical Institute, the Delhi Center. And so, Professor Ghate, can you share your slides with us? Thank you. You have 10 minutes.
Hi, thanks very much for inviting me to present and to discuss this paper. It's a very nice paper, and I've also enjoyed a lot of the other papers in the conference over the last few days, so it's been very nice. So this is an important paper because it provides kind of the first exhaustive preliminary assessment of India's experience with inflation targeting. And I'll just point out that prior to the de jure adoption of inflation targeting in 2016, when the RBI Act was amended to allow for the MPC to decide the policy rate, and prior to that it was the governor who was deciding the policy rate, there was already a de facto adoption of inflation targeting, starting with the submission of the Urjit Patel Committee report in January 2014. And a lot of the recommendations of that report were actually enacted in the April 1 next financial year, 2014-15. So for instance, there was a shift towards headline CPI being the dominant anchor. There was publishing of a monetary policy report and many other changes. So you actually should be getting close to 2 more years of observations if you really want to think of India's IT experience as being slightly before its de jure adoption in 2016. And what the paper finds is that based on an estimation of the reaction function, that the RBI was true to its dual mandate, which was price stability, keeping in mind the objective of growth. And during this period that the authors analyzed, and I was on the MPC during this period, there was a tremendous pushback in India against inflation targeting. The criticism was the Reserve Bank was keeping real interest rates high, that had choked off demand, that was leading to growth to fall. And so in some ways, this paper is a pushback against the pushback, which is nice. It's a defense of inflation targeting and its merits, and that it did work as intended, because the central bank was sensitive to the second part of its mandate, which is keeping in mind the objective of growth, and it wasn't an inflation nutter. Now, the paper has lots of empirical results, and I don't have time to summarize all of them, but one of the criticisms of the adoption of inflation targeting in India has been for many years is that food tends to be a large part of the consumer price basket. 46% with fuel, that tends to be about 52%. So the argument is that since you can't control the price of food and fuel, because these are essentially governed by supply side shocks, the efficacy of inflation targeting goes down. But the authors show that food price inflation did have a larger and consistent impact on core inflation, and not vice versa. And therefore, they argue that that the central bank should worry about food price inflation. What's missing here is a structural discussion of why this happens, and I will talk a little bit about this later. And then the report kind of an entire laundry list of both inflation-related outcomes and other broader macroeconomy related outcomes, inflationary expectations, stock market performance, the weighted average call money rate, which is the overnight wholesale money market rate, and they find that they're all lower and more stable post-IT adoption. There are endogenous IT issues here, but as Rishabh clarified, they're not trying to say a causal story here, but they're just trying to report that pre-post IT volatility and many inflation and inflation ancillary variables fell. Then they find that inflationary expectations, both survey professional forecasters and households, are better anchored both ways, both from actual to headline, actual to inflationary expectations, and also from household. One of the things that is difficult to use with the household inflationary expectation data is that the current assessment of inflation by households tends to be 3 to 4 percentage points higher than reported CPI headline inflation. And therefore, their 3-month and 1-year ahead inflationary expectations for households feeds off of a high current assessment. But what they find is that from inflationary expectations to actual headline inflation, there's no impact. And this is generally muted for the survey of professional forecasters. And I think what is somewhat missing here is some differentiation between the 3-month inflationary expectation, which is tends to move with the price of fuel, for instance, and the price of food, and the 1 year, and the 1 year certainly towards the end of the MPC, the first phase of the MPC around 2020, certainly seemed to show that while the 3-month ahead inflationary expectation was spiking when there were food price changes, the 1 year ahead wasn't, suggesting that market participants or households had faith that the central bank was going to react and bring inflation back down to target. And this discussion of differentiating between the 3-month and 1 year is somewhat missing here, but this is an interesting result, and I'll have more to say on this later. The authors also find that the anti-inflation credibility gained by inflation targeting by the RBI allowed it to move big and early, starting in March to May 2020, in the first time COVID began to kind of play up, and that gave it more policy room to maneuver. So they compare the policy cut amongst ITers and non-ITers, and they show that the ITers were able to move much more. And they also find that monetary transmission from money market rates to bank lending and deposit rates, and this is the second leg of monetary transmission, did not improve with adoption of FIT, flexible inflation targeting. The first leg tends to work pretty well. That's from the policy rate to a whole set of money market rates and even bond rates up to basically 2 years. It's the second leg that is problematical, but I'll just mention and maybe just remind the authors, and they probably already know this, that in October 2019, the Reserve Bank shifted to external benchmarking. So all scheduled commercial banks had to link new floating rates to an external benchmark published by the Financial Benchmark of India Limited. And this was a whole set of rates, and they could choose one of them. And therefore, the transmission to floating rates improved substantially after this policy shift. Although the transmission to legacy loans continued to be invariant and continue to be sticky, because those loans were essentially priced off the marginal cost of lending rate regime, and these were priced off an external benchmark, which was changing and which they had to adjust their rates according to. And the idea of external benchmarking was that it would break the transmission, the lending rate setting from the cost of funds or the cost of deposits, because it was now linked to a rate published by the FPIL. So the paper it's very well written, it's very detailed, it's an important paper, but I guess my overall comment is, and in some ways the paper is music to my ears, is that the authors obtain their results, which is that inflation went down during the inflation targeting period, that the Reserve Bank was concerned about the output gap, it was concerned about its human, and these results hold over a period where there were numerous shocks. So there was an asset quality review in 2015, which led to a bump up in the quantum of non-performing loans in the economy, which actually put several scheduled commercial banks under prompt corrective action, which prevented them from lending, which sowed the seeds to the shadow banking crisis later on. There was demonetization in 2016, which led to a 80% cut in currency, or roughly 60% reduction in base money. But then, of course, since people could put deposits back into banks, that led to a fairly rapid rise, and equal rise more or less in M1, offsetting that shock. A shadow banking crisis that I just mentioned, a major non-banking financial company, ILNFS, defaulted on its debt in September 2018. There were benign terms of trade, which helped the MPC, and now there's COVID. So these shocks happen, and the authors are somewhat silent on this. They don't really explain how these results happen in light of these shocks. And let me conjecture that maybe one reason that this is probably happening is because of data problems at the measurement of GDP. So you see these large discrepancies between the supply side and demand side. So GDP measured using gross value added and GDP measured at market prices. And since the informal sector numbers are largely imputed off the performance of the formal economy, and if many of these shocks didn't really affect the formal economy, they would not get the true hit from them, so to speak, would not get picked up, or would not get picked up in a way, at least until we get the current set of surveys to show how the informal economy got affected. The second thing is that the good results of the paper seem to suggest that monetary transmission works. But we know that the channels of transmission in India are weak, and so the results hold despite the channels of transmission being weak. And I think here there's also maybe not so much of a discussion about what channel of transmission do the authors have in mind. It seems that it's a standard interest rate channel, although the bulk of evidence seems to suggest that the predominant channel is essentially a credit channel. But then there's no discussion of credit growth in the shadow banking from the non-banking financial companies and their synergies with scheduled commercial banks. So those are all, I think, lacuna or bits and pieces of information that could be fit in. And I think also related to this is a discussion again of why they get the results they do. It could partly be credibility, which is I think the main story that the authors are making, but it could also be some form of an attenuation principle that in light of all this uncertainty in terms of the shocks that you can see up on the slide, it made sense to attenuate your policy response. And you show later that, and I'll talk about a bit about this in a second, you show later that the lag value of the interest rate has a statistically significant coefficient, which confirms that the MPC wanted to be careful because it was dealing with this uncertainty created by these shocks. So the attenuation principle meant that it should be careful. Or was the dovish or the focus on growth that the authors pick up come from a change in the governor, because Urjit Patel remitted office in December 2018, and then the MPC became substantially more dovish, and starting from the February 2019 policy meeting. So these are all institutional changes, and a discussion of shocks that are missing in the paper. It would help a lot to address these in some form. And also, this paper was first presented, if I remember correctly, sometime last year, a year ago. And since then, the Reserve Bank of India has published its report on currency and finance, which is the intellectual defense, so to speak, of continuing with inflation targeting for another 5 years. And they cite this paper, but it would help also for the authors to distinguish or differentiate a little bit between what they find and what the report on currency finds. Okay, so now let me quickly run through the specific comments I have in my remaining time, and I'll be quick. Is that the authors estimate a reaction function where they look at the policy rate as a reaction to the output gap, inflation, lagged interest rates. And they find that the estimated coefficients are small but significant under OLS and GMM. If you can see from the presentation that the sample size is quite small, and GMM is shown to be biased in small samples. In fact, it would be good for the authors to use either MLE or iterated GMM or two-step GMM, and maybe just ascertain that this coefficient is not larger than they make out to be. Again, as I said before, it would help a lot for the authors to specify what transmission channel they have in mind. They seem to be talking about an interest rate channel, but they keep talking about an expectations channel. But if they do have a forward-looking channel in mind, then they should really be using a forward-looking version of the Taylor rule to estimate their reaction function. And they should do the same with the version of the equation where they have a variable of interest with pre and post GFC dummies and IT. Take into account the forward-looking part of inflation targeting. On credibility, what I would like to say is that many central banks adopt FIT just as a bona fide. In other words, they're doing fine. It's one more thing for them to do. But for in India's case, there was high and variable inflation prior to the adoption of inflation targeting, and FIT was adopted to deal with the credibility challenge. But I think what made the credibility signal even stronger was not how the Reserve Bank dealt with a standard demand shock, which would lead to divine coincidence, right? So they could, if the economy overheated, they could raise real rates and bring inflation down and the output and reduce the output gap. but it was how it dealt with the supply shocks, where the central bank would need to make a decision about stabilizing inflation or stabilizing output. And because it was more willing to accept a higher negative output gap when it reduced inflation, I think that led the RBI more credibility as an inflation targeter. And you know, they could check this by looking at the sacrifice ratio in later years. And there's a little bit of the results clashing with the Lucas critique. It is true that they're only looking at the inflation targeting period, but the fact that they have time invariant estimates means that may be clashing a little bit into the Lucas critique, but there is some literature which the authors could cite, which use these unobserved component stochastic volatility models to capture the long-term anchoring of inflationary expectations. These results actually support what the authors do. They could also calculate, and this is very easy to do using Cicchetti's 2006 paper, the efficiency of the monetary policy frontier, and see whether, with the advent of IT, there was an inward shift of the policy frontier. And Schmidt, Hebel, and Carrasco have a nice paper, and they say, well, you know, we can go back and forth about comparing first and second moments pre-IT and post-IT, but really what you want to do is trace out this policy frontier and see how it has declined over the post-FIT period. And my final set of comments are going back to the credit channel and the role of NBFCs versus SCFPs, as scheduled commercial banks, which isn't played out, is that they find that during COVID, the ITers were able to cut much more. And part of the reason is that they gained a lot of credibility, which allowed them to cut more. But one concern I have here is that in the broad instruments that they use, like real GDP in 2010, it's not clear whether these instruments are applicable or directly pertain to country-specific characteristics that could be determining this result. In other words, there could be advanced economies that are part of the IT sample that have, you know, strong institutions that could be driving the result. But they're using broad instruments, and it would be good if they actually use or adjust for more country-specific characteristics in these results. And finally, on food inflation, there's a DSG literature following Aoki's 2001 very nice paper, again at the self of some shameless self-promotion, building on this, arguing that food price shocks are essentially intersectoral terms of trade shocks, and these intersectoral terms of trade shocks affect the value of marginal products of labor in different sectors, which then feeds into real wage changes, and then that feeds into demand for different goods and decisions on labor supply. And so there are mechanisms through which food price shocks impact core inflation, but the authors are silent on that, and they could actually provide a more cohesive story on why they get the result this way. So I'll just end by saying that it's a very nice paper. It's an important paper. The authors rightfully emphasize that it's preliminary, and preliminary means partly that the sample sizes are small. But I think the story is still quite nice. But they could beef it up a little bit by giving us more structural interpretation of the results that they find. Thank you.
Okay, thanks for that detailed discussion, and I don't see any questions in the chat, and so I'll just add one more question to the menu, but again, maybe choose from the discussants' points to respond to them. But I'm just saying I was interested in the result, the household survey. You didn't get the same results of the inflation affecting the expectations differently that you did for the professional forecaster. Somehow I didn't find that. I'm wondering if you had an explanation for that. I didn't find it that surprising, sort of based on my observation of professional forecasters versus household forecasting in other settings where the household forecasts seem a little less flexible, if you will. But I wonder if you had an explanation for that. But please go ahead, Rishabh. We're sort of out of time, so maybe if you can take 5-10 minutes max to respond?
Yeah, I'll quickly go through the comments. So, firstly, thanks, sir, for the very nice critique of this paper. So, I'll start with this structural discussion on food to core. I think we can, there's a scope to give more structural explanation using theoretical models, and as you pointed out on the value, how marginal productivities of labor are affected. So we can update the analysis. And on the transmission, we have not given a proper model like a VAR or SVR model to explain the transmission mechanisms, but it was through the changes in the call money rates and the other secondary variables which we pointed out that we do not establish causality. As I said, it was more about saying that these variables on an average has been more responsive, and as you correctly pointed out, there will be endogeneity issues. So we need more structural models, and I think the work on the transmission is still weak, and we are working on it. So structural VAR model is what we had in mind. And on the shocks, different shocks, why we are silent, because we have data issues. Obviously, here we can't put dummy for each and every shocks we have seen starting 2015, and surprisingly, everything happened in this IT regime only. GST in 2017, demonetization in 16, and on the AQR. So one point here, the introduction of AQR is perhaps we see as a defense for IT control. Like some critics have pointed out that during the IT regime, the interest rates have been higher, and that is hurting the investment. But as in the economic survey, the recent economic survey published by Ministry of Finance, they find that it's the asset quality review was one of the factors which led to this. Twin balance sheet problems, and hence further deterioration in the investment. So we don't really. So that's something of a defense, we think, for the IT, that it's not just the real interest rate, but the introduction of this more institutional changes, which led to cleaning up of the balance sheet and would obviously uh, hurt the investment. Although these shocks could be temporary, then a more comprehensive analysis will better guide us on this. And lastly, on the GMM estimates, you mentioned about estimating using MLE and iterative GME. So actually, that was the problem we faced initially when we were comparing the pre-post IT using GMM, because if we estimated for a small sample of inflation targeting period, then that's very small. And so we did estimate for the whole period, and what we did was a non-parametric way of arguing, where we showed the scatter plots and just controlling for other factors. We show that response to output was still the same, but response like the correlation between policy rates and inflation has perhaps weakened. So there we move to more non-parametric ways instead of going with the GMM. Uh, Yeah, and lastly, your comment on COVID and credibility part, where you mentioned whether other factors were controlled. So we controlled for the inflation in the average inflation in the end of 2019 and the policy rates. And yeah, you're right. Right, maybe that there could be other factors as well. But when we use this IV indicator, like other accountability measures, so we think like the results were robust to different choice of IVs. And the standard test of I think Hosman test we conducted to test whether this IV is whether it's a good IV or not. So that did qualify in some cases, and so we concluded with this COVID credibility part. But still, as I mentioned, as a caveat of this study, it's the situation is evolving, and the study ends in May 20. So we need more expectations. And lastly, on Dr. Peckel's comment on why expectations, household expectations, have been differing from professionals. So there, we don't find that. So. We don't find that current inflation the pass through from current to household expectations has weakened under the IT regime. But in general, we do find that they have fallen. And as I pointed out before, there's a systematic bias in the household expectations. So I think, again, there will be more data issues. And there are studies which do a careful analysis, although I haven't come across the one which do this pre-post IT on this. Pre-post IT analysis of household expectations in a more rigorous way, where at a micro level, the behavior of households are analyzed. But broadly, there's a systematic bias in the series, and and there's a fall, but the systematic bias still is there.
Okay, well, thank you very much, Rishabh, for your response and presentation, and Chetan for the excellent discussion. One thing I've been chairing this session, this CEBRA session for a number of years, and mostly in the physical format, obviously. But one thing I find really a pleasure with the virtual format and getting the sort of having the globe to choose from in terms of inviting discussants is the match of discussants to paper presenters. It can be really quite precise. We're getting really good matches here, and I think we're learning a lot as a result. Everyone who can come in, I want to thank you both for excellent contributing to our understanding what's happening in India. And with that, I'll call the first half of the CEBRA session to a close. We're going to take a break until 12 midnight Singapore time, and then we'll get started with the third paper and the fourth paper. So we'll see you back here in about 26 minutes.
Thank you.
Thank you.
Thanks, Rishabh.
Thanks.